Hello and welcome back to my YouTube channel. In today's video, we're going to learn on IFRS 2, share-based payment. Bit of a background on IFRS 2. So a share-based payment is accounted for under IFRS 2 like we know, and if it meets the definition of a share-based payment transaction. The accounting standard does not contain a standalone definition of a share-based payment, but provides a two-step definition using the terms share-based payment arrangement and share-based payment transaction. A share-based payment arrangement is an arrangement between the entity and another party, including employees of the entity, that, provided the specified vesting conditions are met, entitles the other party to receive a cash or other assets of the entity for amounts that are based on the price or value of the equity instrument, including shares or share options of the entity or another group entity, or equity instruments, including shares or share options of the entity or another group entity. All right. A share-based payment transaction, on the other hand, is a transaction in which the entity A receives goods or services from the supplier of those goods or services, including employees, in a share-based payment arrangement, or B incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives the goods or services. So basic features that we need to think about when we look at share-based payment transaction. One is that the reporting entity received the goods or services like we are noted below, and that the reporting entity settles the transaction in its own equity instrument or a payment based on its own equity instrument, that is, the transaction is share-based. Consolidation in form of share-based payment. In its basic form, a share-based payment transaction requires the entity to settle the transaction by either transferring its own equity instrument or making payment in cash or other assets for amounts that are based on the price or value of its equity instrument. So depending on the type of consideration to be paid, the payment is referred to as either equity settled, cash settled share-based payment. We will look at this in details and look at some worked examples for these two classifications. So before classification is considered, it is necessary to consider what constitutes an equity instrument under IFRS 2. An equity instrument is a contract that evidences a residual interest in the asset of an entity after deducting all of its liability. The most common example of equity instruments used for share-based payments are ordinary shares and written call options or warrants issued over ordinary shares, share options, and equity instruments for the purpose of IFRS 2 can include redeemable shares as well. And a share-based payment might involve granting preference shares or shares of one class of ordinary shares in circumstances in which there is more than one class of ordinary shares. In both of these cases, the instrument granted may be a right to a residual interest in an entity and therefore an equity. Right, equity instrument of the entity. The issue of what is an equity instrument of the entity is of particular interest in consolidated financial statement. In the consolidated financial statement, equity instrument of the entity comprises equity instrument for an entity that is included in the group, that is the parent and its subsidiaries. So let's see what the basis of a cash payment. So if the entity does not settle in its own equity instruments by issuing shares, but in a payment of cash or other asset, then the amount is a share-based payment if it is paid on the price or value of its equity instrument or the equity instrument of another entity in the same group. And a common example of a cash payment based on equity instrument of the entity is when an entity grants the share appreciation rights (SARs) to its employees. The share appreciation rights entitle the holder to receive a cash payment that equals the increase in value of the shares from a specified level over a specified period of time, that is, from grant date to settlement date. In this case, the counterparty directly participates in changing the value of the underlying equity instrument, and accordingly, the cash payment is based on the price or value of the equity instrument. So this is also determined up to the point of settlement when the amount is to be paid to the employee. All right. Another common example of a cash-settled share-based payment is a payment based on the value of an equity instrument at a specified date, that is, at a vesting date or settlement date, rather than on the increase in value. So let's see some basic scope examples. The following are basic scope examples that illustrate the analysis of the basic features of a share-based payment in determining if a transaction is in scope of IFRS 2 or not. So the first scenario is that entity B grants 10 shares to its employees, provided that they remain in service for the next 12 months. So this falls within the scope of IFRS 2. The rationale for this is that this is an equity-settled share-based payment. The employees will receive the shares of B or company B if they provide the required period of services to the entity. The second scenario is entity C grants the employee a cash bonus equals to C's share price growth, provided that they also remain in service over the next 12 months. Again, this falls within the scope of IFRS 2. Rationale being that this is a cash-settled share-based payment. Company C has the obligation to pay cash based on the change in the share price to the employees who provide the required services. This award is also known as the SARS, like we explained previously, which is the share appreciation right. So the other scenario we have in here is that entity E's share price is 120. E awards a cash bonus of 120 to employees, payable in 1 year to those who remain in service during the next 12 months. This is not a share-based payment, although the payment to the employees is linked to delivery of services from the employees. The payment is not based on the share price of company A. So for example, if the share price increases or decreases over the period, the employees will still receive the 120. So in this case, the award is considered as an employee benefit in the scope of IAS 19. Then the last scenario we have in here is the entity D awards a cash bonus of 500 to employees, payable in 1 year to those who remain in service, if this share price exceeds a price of 10 per share during the next 12 months. This is out of the scope of IFRS 2. So this is not a share-based payment situation, although company D has an obligation if the share price related target is met and the employees provide the required services. The amount of the payment is not based on the share price of company D. So this award again is also considered as an employee benefit and within the scope of IAS 19. So we'll come to the end of this video. The next video will talk about classification, recognition, and measurement of share-based payment. Thank you for watching and see you in the next video. Bye.